Hello, self-storage investors. Coach Rowell here with a brief market update on March 23rd, 2020. I wanted to take you on a quick little trip down memory lane and give you a big picture overview of the stock market over the last 25 years and then quickly zoom into the last 12 months and really see what's been happening over the last few weeks, really, and bring to light an interesting little side effect and what's been happening with the US dollar versus some international currencies. So to put things into context here is the S&P index, which is a pretty good representation of the entire US stock market as a whole from 1995 through to just a few weeks ago. And then there's this significant series of red bars that are going down. And what's happening here? So let's zoom in here to a 12-month chart, and you can see here that the peak in recent history is February 19th, 2020, and at that point the financial markets finally realized that this is not just an epidemic that is contained or specific to China, but it's truly becoming a global pandemic, and which caused this massive sell-off in U.S. stocks. Then there was a bit of a recovery here, which traders affectionately call a dead cat bounce, which is a false recovery because the downward pressures, the selling pressures persisted, and you can see here there's selling, and drop in prices, which brings us right down here to March 20th, Friday, March 20th, just a few days ago, that's where the trading ended on a low note down there. Now, in a nutshell, why are the stock market prices going down? Basically, if you can imagine the big money managers, we call it big money managers of mutual funds, pension funds, hedge funds, like these managers of large pools of money, they basically are expecting that there's going to be a significant decrease in business revenues in all industries right now. And they're correct because, as you're probably experiencing in your own local hometown, that there aren't a lot of people who are going out and spending money like they used to. And the difference is right now, as opposed to the previous correction, major correction that happened in 2008, is this is like systemic. This is all industries. However, I did come across this interesting article that I wanted to share with you in the Wall Street Journal. If I can find my window here, that said, interestingly enough, here we go. The Wall Street Journal reported that investors flock to self-storage rental housing as safety plays. Quite interesting. They're looking at self-storage as a safety play amidst all this craziness that's going on right now. And as you probably heard, we like to say that we're in the trauma and transition industry, where people, if they need to quickly change their living arrangements or if businesses need to shut down, unfortunately, it's kind of difficult for them to liquidate all the contents of either their personal home or their business. So they seek out a very cost-effective short-term solution in some cases, and put their contents into self-storage, which oftentimes start off as a short-term solution, but will actually extend to a longer-term solution. So interesting how some big real estate investment trusts are focusing on that, and the Wall Street Journal is recognizing self-storage as a safety play. Now, amidst all of this turmoil, we have seen the Federal Reserve try to calm the markets down a little bit and keep the money flowing around the economy. On March 15th, last week, that was a Sunday, by the way, they had an emergency meeting and they took a drastic measure and they cut their Federal Reserve rate 100 basis points from a range of 1% to 1.25% all the way down to 0 to 0.25%. It's always a range. Now, this is drastic, it's drastic, but it's significant because typically when the U.S. Federal Reserve makes an adjustment to their benchmark rate, they usually just notch it a quarter of a percent up or down. Now, why are they doing this? Because, as I mentioned, they're trying to make money cheap and trying to encourage people to continue spending. However, as we saw last week from Monday to Wednesday and even into Thursday, it really didn't have a whole lot of positive effect in terms of restoring confidence to the marketplace. So we still saw significant sell-offs in the stock market. And then on Wednesday night, March 18th, Trump signed a bill providing paid sick leave and free testing for coronavirus and other benefits like food assistance and medical assistance to people, which we can see actually the effect that happened in the currency markets. Here I show you the US dollar versus the Canadian dollar, and you can see here that the US dollar was just surging in value compared to the Canadian dollar. And then on March 18th, when Trump signed that bill, March 19th, it caused a pause in the trajectory of those two currency pairs, and it caused a bit of a reversal. Now, what's happening here, the reason why the US dollar is actually increasing in value quite a bit is the fact that all of these money managers selling off their US stocks, and where are they going? They're sitting in US dollars, which, if you think about it, has created a massive, massive spike in demand for US dollars. And whenever there's a massive spike in demand in anything, it causes that thing to increase in price value. So that's why you see the US dollar currency actually spiking in value versus all other currencies, as you can see here with the euro US dollar currency pair. You can see the euro was increasing in value until March 9th, pardon me, and then that's when the euro started to lose strength compared to the US dollar, or the US dollar gaining strength against the euro, because it's seen as really the safest place right here, right now. The safest place to put money is in US dollar currency. So with that massive demand causes strength in the US dollar. And then again, March 18th, when Trump signed that bill, it caused a bit of a reversal. Now, there is also another bill that is currently being debated in the US federal government that is estimated at about $1.6 trillion worth of a stimulus package. Put that into context, the $800 billion stimulus package that the Obama administration had introduced during the financial crisis was literally half, 800 billion versus 1.6 trillion. Excuse me, the 1.6 trillion package being tabled right now and currently being debated. So hopefully they can get on the same page with that, so they can get down to the business of actually deploying this stimulus package to the general public, because it's not just the financial institutions that are needing bailing out, but really just about every other industry that's out there right now. Question I often get these days right now is, are we in a recession, Coach Roel? And the technical answer is no. We are not in a recession right now, because by definition, a recession means 2 consecutive quarters of negative GDP growth. So the definition of a recession is kind of inherently flawed, because the only way that you know that you're in a recession is when you're already deep into the recession, if that makes any sense. Because if we imagine ourselves 4 or 5 months into the future, we'll look back and quite possibly would look back to February 19th as the beginning of that recession, but we, by definition, we don't know until we see more data coming through. The question then comes to, are we in a bear market? And the answer is a confident and a resounding yes, because the definition of a bear market is a 20% or more drop from the previous peak of stock prices. And as we sit right now at March 23rd, 2020, we are at about a 33% drop from the previous peak, which was February 19th. To bring it a little bit closer to home, what can the passive investor do? Passive investor meaning the more traditional retirement funds, mutual funds, that sort of thing. Well, stay the course. That is always the general suggestion, because to put things into context, if your target retirement date is 7 years plus, and the longer, the further away, the better, the more reason that you should really stay the course, because as the saying goes, this too shall pass, because every down market, 100% of the time, no exception, is always followed by a recovery period, right? And by definition, that always happens. So this will eventually pass. It might take a few years, it might take several years, but eventually it will go back up. So the younger you are, or the further away from your target retirement date, the more you have reason to really stay the course. Now, you may need to also evaluate or reevaluate your risk tolerance, because if you're feeling really anxious about the drop in your retirement savings right now, then that's probably a pretty good sign that you're really not an aggressive investor with your mutual funds. A little bit of outside the box sort of suggestion that I write about in my book is it might be a good time to actually apply for additional or new credit to serve as a more emergency funds. Where I'm coming from is this: I would rather see you in a position where you have the additional credit and not need it, versus need the additional credit and not have it. So that's my version of being a little bit more conservative. So it might be a good idea to expand your available credit while institutions still have not changed their policies so much. What can the active investor do then, from the real estate investors, self-storage investor sort of side of each and every one of us? I would say I would have a little word of a caution. Think carefully about your next move. This is not the time to be really aggressive just yet. This down market just started, albeit it dropped really quickly. It hasn't yet spread out to like the real estate market in general just yet. Now again, I'm probably on the same page as you in the coming weeks and months. I do expect a drop in real estate asset prices, but we won't know that, and we can't really say that for sure because no one can predict the future. So now is not really the time to be super aggressive. What you can do is ensure that your books are in order, because if you are a believer and actively investing in using other people's money, then those other people will probably want to make sure that you've got your books in order and that you're in a good position yourself personally as well as business-wise. And it also might be a good reason, a good excuse right now to review your current leverage positions and see if there's, if your institutional lenders have any short-term policies where they are looking to lower interest rates or even defer payments, because there's a lot of talk of that happening right now. So not a complete overview of everything and anything and everything, but a quick little update with the context, in the context of self-storage investing and some retirement savings from yours truly, Coach Roel, on March 23rd, 2020. I hope to see you again in the near future at another market update.